Hi, if you're just joining this YouTube channel for the first time, my name is Miracle Naji. I started my career as a management consultant and currently I work as an investment professional within the venture capital space. I started a series on venture capital that is aimed towards breaking down all you need to know about venture capital. And if you're a founder, an entrepreneur in a startup, you're going to find this series very helpful because I'm going to give you real-time insights into how venture capital operates and how you can leverage it for your business. So please try as much as possible to subscribe. So on the screen here, I have about six different sources of venture capital type of investment that you can possibly turn to when you need funding, right? Because as I mentioned in one of my videos, that it's often difficult for startups to raise capital from traditional sources of capital like banks because of the high risk involved and because they are not even seeing enough operating cash flows to repay back the loans and to service the loans and repay back the principal. So that's why a group of other sources of investment of that's why a group of other sources of funding has emerged for startups. And in this video, I'm going to be breaking down six of them. So the first one I have on my screen here is funding from accelerators and incubators. So now I just grouped accelerators and incubators together because they typically play at the same stage. So they tend to support the development of ideas from basic concepts into viable business ventures. Whilst on the other hand, that's for the incubator hub. Whilst on the other hand, accelerators support already existing businesses to scale, right? So for an incubator hub, for instance, you are still at that consumption stage. They're able to work with you and improve on your idea more. And sometimes they're able to provide you with seed funding to launch a minimal viable product or do that initial market test or pilot of your product. On the other hand, accelerators, they tend to work with businesses that at least have startups that have a minimum viable product and they are looking to scale up. So the accelerators tend to work with these startups more closely in order to get them to the next stage. And a good number of them will often provide capital to the business. I know, for instance, Techstars do provide $120,000 for all the startups that tend to pass through the accelerator program, and I think for around between 6 to 10% ownership stake standard when they provide this funding. So that's for accelerators and incubators, and there are several accelerators and incubators out there. The most popular one being Y Combinator, which is like the biggest accelerator program in the world. And then in Nigeria, we also have some accelerator programs and hubs like Renovation Hub. Then we also have crowdfunding as a source. So these are platforms that allow startups to raise funds from a pool of non-accredited investors because of the unique asset class like that. Because startup is a unique asset class, not every investor are supposed to participate in that sort of investment. So the investors that tend to participate are people that have higher risk appetites and we want higher returns on their investment. So there are platforms that aggregate these different type of investors and provide the capital to the startup. The popular one being Start Engine. Then the third one I will be talking about is angel investors. Now, angel investors are high net worth individuals who commit capital to support early stage startups. They can also commit capital to support early stage startups. The unique characteristics about angel investors is that they're usually high net worth individuals and they tend to invest their own money. And aside from investing their own money, they also provide guidance and mentorship to the startup. Another critical uniqueness about angel investors is that they come at a very, very, very early stage of the company. Sometimes when the company is just a pitch deck and the founder just has an ambition. So the angel investors tend to provide them those small check size that they need to get to the next stage. The next one we're now going to be talking about, if you have seen much of it, is the venture capital. And before that, I would also like to mention that sometimes angel investors can operate as a network to form a syndicate whereby they put their own money together. A group of two, three, four, five other angel investors, they put their money together and then invest into the startup. An example of an angel network in Nigeria is the Lagos Angel Network. I also have other ones like Tequila. We also have TBC Labs. Now, we also talk about venture capital. So they are usually institutional funds that invest in early stage and growth stage and startups, often tech companies. We've seen this in the previous video. Now, the unique thing about venture capital firms is that they don't tend to invest their own money. They raise investments from a class of individuals, a class of investors known as limited partners. And with the funding that they raise, they now invest it into startups. An example of venture capital firm in this part of the world is venture platform, and we also have the Anderson Harrow, we have Harrow, we have Sequoia Capital. So these are very, very large venture capital firms. If you really want to learn more about a brief overview of venture capital, I would suggest you watch my previous video. The next one is private equity firms. So sometimes they use a combination of debt and cash to fund mature and late stage startup companies. Now, I know this may be a new concept, but in the next video, I'm going to be breaking down the different stages of growth of a startup, where you get to see that there are startups that are in the early stage, the growth stage, and the late stage. And different investors tend to play at these different stages of the companies. And for private equity firms, which are institutional funds that tend to provide capital to companies that are not listed on the public market, they tend to play at that point whereby a startup is a late stage company. That means they have crossed all those early stage, growth stage, and they're just expanding their products into new markets and growing large and large. So that's for private equity firms. They're also a good source of capital to startup companies. And increasingly, we are seeing private equity firms move down the line from focusing on just late stage investment to also doing growth stage based investment. Then the sixth one I will be talking about is government grants and subsidies. So startups can receive non-equity and equity-based investment from some government initiative like sovereign wealth funds. So these sovereign wealth funds, they tend to traditionally they invest into infrastructure, they invest into real estate, but more and more we are now seeing sovereign wealth funds pay attention to this new asset class, which is startup investing. For instance, the Nigerian Sovereign Investment Authority last year launched the NSIA Prize for Innovation, during which they invested 250,000 US dollars in about 10 different startups, right? And at the end of the day, they are going to be taking equity ownership stake in those businesses. So in summary, there are six different other sources of funding that you can be able to pursue, and each of them comes with their own uniqueness, and each of them tend to have a focus on the stage of the company where they will decide to invest into. So in the next video, I'm going to be breaking down the different stages in the startup journey, taking you through pre-seed, seed, pre-series A, late stage of a startup. So that will really help you. So in the next video, I'm going to be breaking down all the different stages of a startup growth, from the pre-seed to the seed to the series A to the series B, and more late stage fundraising round. So please and please subscribe to this YouTube channel, subscribe to Miracle in Nigeria to get more, to get updates when I drop that next video. See you in the next video.